Welcome to Boyce & Associates Wealth Consulting Charts and Chat for October 23rd of 2023. This is Eric Boyce, President, CEO, and Chief Investment Officer. Well, we certainly do have a lot of charts to get through, a lot of data this week, so I'll try to be very efficient getting through these slides. Here we have the leading economic indicator index. We've got the month-over-month change on the left, and then we've got the number of consecutive monthly declines here on the right. So that number is now 18. You can see the spike in 2008, which was obviously a recessionary year. So, you can see the red bar there. We were making a little bit of progress on the LEI, but a little bit of an increase there. We've got a chart that will kind of highlight the components of that coming up. And here we have the components of the LEI over the last month. You can see ISM, Institute for Supply Management, new orders were down. Consumer expectations are off. Interest rate spreads are still negative, but not as much as they were. We'll talk about that in a second. And we've got credit, which is tighter. Building permits that are down, and then obviously the stock market's been volatile. Those are the primary components that weighed on the LEI. And many of those have weighed on the LEI for a number of months now. And again, so we're now counting 18 consecutive months here of a decline in the leading economic indicators. We've got a chart coming up, which we'll talk about the LEI, the leading indicators over the coincident indicators, and what that means and what that perhaps suggests to us. And here we have the slide with the leading economic index, the LEI, divided by the coincident economic index, the CEI. And usually when you have this number going down, it tells you that the coincident numbers are a little bit stronger than what you see on the leading side. We know the leading economic indicators have been down 18 straight months. And so current data is still relatively positive, but we're just flat running out of steam here a little bit. And so this portends a slowing economic condition. This number tends to foreshadow a recession. You can see the gray bars that are overlaid here and how that typically maps out. So when you have a fairly pronounced drop in this particular data series, it usually does lead to a recession. And, I've spent a lot of time this week talking to practitioners and talking to other industry professionals and people that have been around the investment business for a long, long time. They are predicting kind of an economic slowdown / mild, shorter recession. So it's pretty consistent with what we've seen, but not all data is aligning that. And we'll talk about that in just a second. This is a data compilation from Oxford Economics, the U.S. Beige Book Activity Index. So this is a summary of all of the Federal Reserve districts around the country and essentially what they're seeing. And so, what we're seeing from the Beige Book side is not consistent with a recession. It's consistent with a slowdown, but we haven't seen those levels that have traditionally been associated with recessions, which is a little bit of a divergence from what we just saw with the LEI over the CEI. Here we have the, in blue, we've got the economic forecast. This is the consensus estimate for the third quarter from a bevy of analysts and so-called experts and whatnot. The baseline there is the Atlanta Fed GDP now. You've heard me talk about that. It has done a really, really good job over the last several years in hitting that GDP number. And right now it's looking for 5.4% economic growth here in the third quarter, which would be absolutely fantastic, but I think relatively short-lived because we are slowing down. But what's interesting here is that you've got the analysts that are now catching up with the Fed, even though they haven't gotten there yet. Current estimate by the consensus here is about 3% economic growth, and I do submit that will be probably the best growth that we'll see for at least the next 6 months. Here we have a probability of the U.S. in recession in 12 months, and that number has fallen a bit. We can see And really, last year, that number really spiked as we were heading into 23, and we thought that 23 was going to be the recession year. I certainly was in that camp too. The consumer's been very, very strong. And frankly, labor has been relatively strong as well. So we didn't see it. And so now that those estimates got pushed out into 24, and obviously we're in the first month of the final quarter, calendar quarter of 2023, and the estimates for recession are actually going down. So a number from KPMG, Diane Swank. I respect her work quite a bit. This is their estimate, and just like you saw a couple slides ago, the Atlanta Fed GDP now predicting about 5%. That's their base case scenario. And, this is just very, kind of emblematic of what we see with a lot of the investment firms. Goldman in particular has really dropped their probability of recession down to like 10%. You saw on that last slide that the consensus is still, just under 50, but going down. But here you see Diane, her base case for fourth quarter is 1.5%, and then 1%, and then kind of slowly easing up, but staying fairly benign. Anywhere between like 1 to 1.5% annualized is pretty slow growth. But what she's saying in her downside scenario, we've got risk of shutdowns, which I honestly think is very real. At this point, we don't have a Speaker of the House, and I think there's still kind of a cognitive dissonance there in Washington. But she's looking for a little bit slower, but not negative growth, and then recouping that growth in the first quarter. I wouldn't say that this is kind of like the blueprint of what I see with all the investment banks, but it kind of fits the narrative that I'm hearing pretty consistently across all the investment banks and the research houses, is that we will see slowing of growth, but maybe not a recession. I thought this was really interesting. Bloomberg, some analysis I was reading in research while I was on the road this past week. This is an analysis of the impact on unemployment of higher Treasury yields. And so obviously that's been probably the narrative of the last month is higher interest rates and Treasury rates moving higher. And we've got some slides on that. Yield curve is kind of flattening to some degree, but as rates move higher, that tends to correlate pretty well with increased layoffs and decreased labor conditions. And so as you can see here, if you have a 0.5 percentage point in increase there in 10-year Treasury yields, and that would tend to suggest about another 0.5% of unemployment rate. And then similarly, if you go up a full percentage point from current levels, and that would kind of portend maybe another full percentage point of unemployment rate increase. So I haven't seen the long run, the research on this, but there is a correlation between higher rates and higher unemployment. Here we have economic sentiment from Penta. This is on the top-hand side, it's kind of like the all-in number. Bottom is reflective of several different questions that are being asked in this survey. I thought that was pretty interesting. Maybe the key takeaway is what you see on the top is that sentiment does seem to be rolling over, and this data series goes back to a year exactly, almost exactly a year ago, and you can see we're back pretty much at the same levels. So sentiment had picked up. Now it's kind of sliding off just a little bit, but you can see probably where the numbers fall off a little bit more down on the bottom. You can see the labor market sentiment maybe edging off a little bit, as well as the economic sentiment there, and really all major categories except for personal finances are sliding a little bit, but they're not falling off a cliff, just to be clear. Here we have a retail price of gasoline. We've talked a lot about this lately. This summer, we did have a bit of a spike that does seem to be rolling over now. We're shifting into kind of the winter blends here, and with the kind of cessation of the driving season, it does appear that we are heading a little bit lower on gasoline prices. Here we have retail sales. So we've got a couple of different things on this here. We've got retail food and service sales. Nominal numbers continue to move higher. It's a good sign if you're looking for economic growth. It's not necessarily as positive if you're trying to navigate a soft landing, and especially if you're the Fed and you look at this data and you see the consumer remains pretty strong. That much is clear. Even inflation adjusted, it does seem to be ticking up a little bit. You can see that in the gray line there. On the right-hand side, it's kind of I call it a super core retail sales number, and you can see that those numbers have been strong ever since March of this year. Here we have median household net worth broken out by cohort. I thought this was really interesting. The first two, going from left to right. First slide here, top 10% net worth moving higher. These are people that tend to hold more stocks and investments, and obviously have greater interests in real estate and their homestead. But net worth has gone up for all families. You can see that in the gray line, even though it's much less pronounced, I should say. And this numbers probably should be logarithm as opposed to aggregate numbers, because most people, obviously in the aggregate don't have a lot of net worth. But you can see that even the bottom 20, they've benefited a little bit, although it's almost imperceptible on this chart, again, because it's not built to kind of a scale here. But middle section here, we've got excess savings. We've talked a lot about that over the last handful of months, and recently that data has been revised a little bit higher on what we have left. We started with about $2 trillion ish of overall excess savings that were being spent. Again, it's helping the consumer. You can see in this chart that it tends to be concentrated in the more wealthier cohorts of the population, but everybody has benefited from that. And so, excess savings is helping to drive consumption, which I think will still be there when we, next year. And I think this is one of the things that helps us get comfortable with the notion of a soft landing, as the consumer is not in a kind of a fail situation. On the far right here, we've got personal savings rates back down to where they were before the pandemic, but they are still positive. And again, we're burning through some of that extra stimulus that we got during the pandemic. Talk a little bit about small business now, and their financial condition. There's a lot of different analyses that are embedded in this chart, but basically I'll just kind of point to the headline here, is that roughly half of all small businesses have floating rate interest based debt. And so what does that mean? Obviously, when rates move higher, that's a greater share of interest that they're having to bear on their financial statement. Obviously more interest that they're having to pay, so on and so forth. Here's another chart with the same research that I read from Goldman Sachs. Here we've got small businesses that tend to spend a larger share of their revenue on interest expense than do large companies. Obviously larger companies have, are better able to bargain. They tend to get lower overall rates, and so as a percent of revenue, they tend to spend less than do small companies. And I think this is really where we're trying to kind of get our arms around this potential slowdown here, because for all the fanfare that these Fortune 1000 companies get, it really is small businesses that drive this whole economy in the U.S. and I'd say many respects around the globe as well. And so this is where we see the stress beginning to build in these smaller companies, not just in the sense of higher interest costs, but the ability to roll over debt amidst a banking sector that is getting increasingly tight. And as we also talked about here in recent weeks, a lot of these smaller companies are having to go to the non-bank sector, and they're having to pay even higher interest rates. So this is definitely something that we want to continue to watch. And here we have some additional data on the impact on small businesses. So this is just showing you that essentially over the next decade, small businesses are going to have to incur about 25 to 30% higher interest expense. So this is going to put more strain on growth. And it's also going to put certainly a strain on profits. And so you talk about like national income, and you talk about, this relationship between gross domestic product, GDP, and gross domestic income, GDI, which are typically pretty close to being the same. Having higher interest costs, if we are set to be higher for longer, i.e. longer equal to, 5 to 10 years, then that could translate into lower overall economic growth. Now, the flip side to the last couple of slides is the fact that, with increased income and cash balances, the earnings rate on those will be higher. So they get to offset some of the higher interest burden with higher interest income off of their excess balances. And so the challenge will be obviously for firms to maintain adequate cash flow, and how they manage that cash flow is going to be pretty important, because near-term cash right now is paying essentially 5.5%. So if you're a company sitting with idle liquidity that you need for contingency, but you don't necessarily need it for working capital, you can obviously make a high rate of return, and this obviously helps to offset the higher interest cost to a large degree. And we turn our focus here briefly to the commercial banking sector, and in particular the regional banks. So what's interesting in some of the research that I've been taking a look at over the last week, the regional banking sector is definitely not out of the woods. We do see increased deposit levels at the smaller bank level, but we also see that the cost of those deposits is relatively high, and you can see that very well depicted here. This data series goes back to the 1980s, and it is cyclical with with interest rate cycles, and I guess a better way to put that is, as interest rates oscillate, so do the cost of funds for these banks, and that's really the big issue for them now. It's like the cost of these funds is higher than what they can generally earn, and that's the challenge for these banks, is to manage their balance sheet while also meeting demand for loans that have good credit, frankly. Now we've got a couple of regional Fed surveys. We've got the Philly Fed and the New York Fed. On the Philly Fed side, this is actually their manufacturing index, which we know has certainly picked up off its lows. You can see that, and that's pretty symptomatic nationwide too, but manufacturing still remains in kind of a contractionary phase, if you will, and remains somewhat sluggish. So we're obviously grateful to see it off its off its low, but it is still an issue out there that we need to follow. But you can see the latest reading was a little bit worse than was expected, even though it's a slight uptick from a month-over-month standpoint. And then on the right-hand side, we got the New York Fed Business Activity Index, again, still in contraction. Now, when you look at both the Philly Fed and the New York Fed, which is also known as the Empire State Survey, one of the positive takeaways, again, if you look at labor, and we know that labor has been relatively strong, although, as we just saw, the study from Bloomberg, that higher interest rates tend to increase the unemployment rate. But for now, at least, in both of these two regional Fed surveys, here we have the employee index as kind of a subcomponent to that. And you can see this data series goes back to 2001, and we've actually seen a bit of an uptick lately. And this slide from Goldman Sachs basically reiterates a point that we've been making for quite some time, is that small businesses are experiencing more difficulty getting credit from the traditional channels. And it's pretty much in line, though, with the early 90s, which this piece shows you, you're going back to this data series that starts in 1986, but you can see the early 90s, and basically around 28 to 2012 here, really the same deal. So, again, not a shocker. We know that businesses are, particularly small businesses, are having a little bit more time rolling their credit, getting new credit. We've already talked about that in the chart pack this week. And I don't think that's necessarily going to change for a little while. Banks are really focused on not only their balance sheets, but also their profit and loss statements as well. Got a couple of things on this chart as we kind of slowly transition into other areas of the economy and the housing market. Here we've got on the left-hand side, Goldman Sachs Financial Conditions Index. Represents tighter financial conditions. Again, we just saw that on the related to small businesses and their ability to get credit from the traditional banking sector. We see tighter financial conditions overall in this index. On the right-hand side, we also see, as it relates more to individuals, and we've got mortgage daily news. We finally hit 8% in the mortgage rate department, and that's obviously a function of 10-year Treasury rates, which, as we know, have been moving higher steadily throughout the last month. Quick data point here from Redfin I thought was interesting. You've got continued rise in the amount of income that you need to basically afford a reasonably priced U.S. home, and where we are relative to August 2012 is essentially more than double that, and over the last basically 10 to 11 years, and you can see how that's changed since the pandemic, and then 2022 and then 2023 with regard to interest rates moving higher has had a profound impact on that whole issue. Existing home sales, not a surprise. We're tracking down to global financial crisis levels. Affordability is really tough right now, especially for new home buyers. You can see that August 2023, we're down at just over 4 million units. And this is a much more important figure than new home sales, because new home sales are just a mere fraction of existing home sales. And with mortgage rates now tipping, or depending on where you are, getting very, very close to 8%, that's going to put a lid on existing home sales for a while. Here we have starts for both single family on the left and multifamily on the right. It's a tale of two different stories right now. Obviously, we're in a pretty significant housing supply problem, and we have been for the last decade. We've been underbuilding ever since the global financial crisis. Has not been keeping up with new household formation and immigration, for that matter, and so we're still trying to, even with affordability being what it is, we're still in a deficit trying to build more homes and get more units on the market. And you can see that starts are moving higher. Builders are being very aggressive on at least the ones that are able to offer credit themselves, that they're buying down that rate by, in some cases, 3.5 percentage points off of the stated mortgage rate. Being very aggressive there. We have built a lot of multifamily, and so that's stalling out. You can see that on the right. So obviously moving in the different direction. Financing for multifamily construction is getting harder because it is considered commercial if you're a developer. And so those permits, you can see, are going down. Here we have a quick look at the global backdrop. I had not seen this data before, really interesting. So, the U.S. is really kind of on an island, as it were, in kind of discussing this housing shortage and the lack of, keeping up with household formation over the last decade or so. And the U.S. is definitely in a league of its own here, because we're still in a deficit, whereas you can see other areas around the world are in fairly terrific surplus, and ostensibly, currency issues notwithstanding, would tend to have more affordability than the U.S. right now. Now we're going to shift our attention to the investment markets, the S&P 500. Here we have the S&P 500 up on the top end side in the blue. This goes back basically a year. You can see the gyrations in the market. We know that, from our October lows, we've had some good moments and bad moments, and certainly over the last, call it the last 2 months, have been particularly challenging. And so the correction that we've seen, from the interim high is now about 7.9, almost 8%. And so you can see that in the bottom half of this chart here. So, it's not uncommon to see corrections in a 5 to 10% category. And this one's been kind of, almost silent to some degree, because it just feels like it's a protracted, and you see like, 2-3 straight days and a few weeks in a row of the market being down, but you don't really feel it. But, the cumulative effect of that has been actually pretty reasonable. And as we'll see in a minute, valuations are not stretched, and this is a healthy thing for the market to do. You don't want it to keep going up forever, because then you tend to get stretched in your valuations, and then you get these resets. And so the market, having corrected now to the tune of about 8%, is in the long run a very healthy thing, because it creates opportunities. Here we have the S&P 500 on a technical side. On the upper hand side, we've got the 200-day moving average in the amber line. You got the index values in blue. And you can see here that we spent about 154 days ending on the 19th here, where the index was above its 200-day moving average. Now, it just dipped below that 200-day moving average. And so what does that mean? That tends to foreshadow a little bit more volatility in the markets in terms of having to set a new base and then try to punch back through that moving average, because once you tend to go through that average, it tends to stay below the moving average for a little while. Here we have a quick look at the Magnificent Seven. You can't get through a discussion on the S&P without talking about these. And honestly, these, Magnificent Seven, these, you can see here Facebook, Apple, Amazon, Google, Microsoft, Nvidia, and Tesla are all part of the Russell 3000 too. And so the story is very much the same. So, we've had a lot of volatility in these stocks, both on the upside and the downside. But if you back out, at least on this chart, it's the S&P 500. If you back out the other 493 stocks, you can see that the returns year to date are actually negative. So the equal weight has really underperformed relative to the overall index to a level that we haven't seen in a very long time. And so these Magnificent Seven have like an outsized impact. But as you'll see in a few slides here, valuations actually are pretty attractive for the rest of the index. If you back out, kind of these frothy, this one kind of very poignant frothy layer that happens to account for almost 30% of the whole index. Here's the same chart, but with the Russell 3000. You can see if you back out the Magnificent Seven here from this analysis, then the Russell 3000 is also negative. The other companies outside of the Magnificent Seven. So, and literally, as the index name would suggest, I mean, we're talking about 2,993 stocks. Again, looking at the S&P 500, you can see that we are coming close to trend lines here on the left-hand side. We've tested that before, just a few weeks ago, and now it looks like we're kind of testing that support level again. This is retracing back to the October lows of last year. Obviously, you want to stay above that, but as we saw, we just broke through on the downside across the 200-day moving average. So technicals are a little bit challenged right now with this correction. On the right-hand side, we see the number of S&P 500 members that are individually trading above their individual 200-day moving averages, and you can see it's now less than half of the index is trading above their 200-day moving average. Now we want to talk about bonds because we have seen dramatic rises in interest rates. So, you've got three different flavors here, and then I've got basically a spread to show you. So on the upper left-hand corner, we've got the 10-year government bond yield just hit 5%. You can see how quickly that has gone up this year. And, and basically from the pandemic lows, we've basically gone from, essentially about a half percentage point all the way up to 5 full percentage points. And, there's a lot to unpack there. The impacts on the regional banking sector with Silicon Valley and a lot of things. Just the virtual destruction of the bond markets last year. And bond markets are still weak this year because of this continued rise in interest rates. So you've got the 10-year at 5%. You've got the 30-year at slightly above 5%, about 5.1%. And then you've got the 2-year in the upper right-hand corner at 5.24%. So obviously the 2-year yield is still above both the 10 and the 30. So we still have an inverted yield curve, but that spread is narrowing quite a bit. The 2 to 10-year spread is now only about 17 basis points or 17/100ths%. You can see that on the lower right there. So we are getting a flattening in the curve, which by, they call it a bear steepener. So, longer rates are moving higher when short-term rates are still stuck in a range. And so you get that bear steepening on the back end. And so that is not helpful for returns. It's good for savers, but, if you're investors in longer duration fixed income assets, you're seeing some notable price declines right now. But once that edges off, this is not inconsistent with what happens in an economic slowdown. You get these rates that come up and it kind of slows the economy down. And then you see the curve then normalize again where short-term rates are below the long-term rates. And that will come at some point, but right now we are seeing a bit of flattening in the yield curve. Here we have the forward earnings yield minus the 10-year. So you think about this as like earnings divided by price of the stock market, and then you subtract from that the 10-year yield, which we just saw was 5%. So with yields moving higher, stocks are becoming a little less competitive to bonds right now, and bonds have certainly sold off, and we've got essentially negative returns for the year to date in fixed income at a time where stocks are have had fits and starts this year, but are now in kind of a contraction or correction mode, as we just talked about. But this tells us, you got to go back to basically, the tech bubble bursting when we saw this issue before, and it just means that stocks from a yield standpoint are a little less competitive relative to bonds right now. We'll talk about valuation of stocks, and you can see the S&P 500 overall is trading about 18 times forward earnings. This is the next 12 months. That's that NTM, next 12 months blended price to earnings ratio. So the all-in index, including the Magnificent Seven, is about 18 times. But if you kind of mute the impact of those and just say, well, if you take all 500 stocks and divide their valuations equally, then that valuation is about a little less than 15, which is not just screaming attractive, but it's a lot more attractive if you look at it on that basis. And as we've already mentioned, the equal weighted index performance is well below the overall index, and that's because of the impact of those Magnificent Sevens, which are exhibiting a lot more volatility right now. Here we have the bond curve, the yield curve I was just talking about on the bond side. You can see, the pink line represents where we are now. So we're flattening out quite a bit from where we were literally 1 week ago. And again, we're not, flat yet. We're still in an inverted state where you can see on the left-hand side, 1 month rates are still about 5.4. And then as we already discussed, the 30-year Treasury is about 5.1%. And talking about the bond market, we spent a lot of time at the end of last year just kind of reflecting on how weak the Bloomberg U.S. Aggregate Index was last year. And you can see here in the red line, it kind of broke all axioms of of history here, and it was down 13%. And again, just to reiterate what you've already heard me say, but last year the major bond index was down 13%. The stock index was down more than that, 16%. And it's the first time we've seen that magnitude of a drop in both the major indices since 1872. Well, rarely do you have 2 consecutive years of negative performance in the bond market, and we're heading towards that this year. Wouldn't have expected it, but we're seeing higher interest rates. The reason why we didn't expect it is we thought that we would have already had a bit of an economic slowdown. These rates would not continue to move up higher, but they would probably stall out and go a little bit lower. I still think that's going to happen. What this is doing actually is setting up what could potentially be a groundbreaking year in fixed income next year if we do have those rates dropping. So, just from an investment standpoint, it does make sense to shift some dollars into longer duration assets as these interest rates are moving higher. And as we're seeing kind of this tangible evidence of some economic slowdown, whether or not we hit a recession, the slowdown will still help fixed income returns over time. But as we sit here at the, in the 3rd week of October, you can't deny the fact that bonds have been weak this year. And, if they do end negative for 2 consecutive years, that would be an extremely rare event. Here we have volatility on both the stock side, the left-hand chart, the VIX. We saw a spike in that. And as we have seen for the better part of 2 months now, volatility on the fixed income side, on the right-hand side here, remains elevated. Quick look at the Russell 2000. This has a lot of small company stocks in it. And honestly, there's a lot of companies in the Russell 2000 that aren't profitable. But from a valuation standpoint, you've got this technical trading range, and they call this consolidating chart pattern because the peaks and valleys tend to narrow out until you hit kind of a convergence point. Right now, Russell 2000 is sold off, again, part of the broader equity market correction, but actually looking not unattractive here if you're looking at it purely from a technical standpoint. Here we have the S&P 500 equal weighted index over the S&P 500 all-in index. And this is a chart that I pulled from a Liz Ann Saunders piece. She's chief strategist for Charles Schwab. And I talked about this earlier, but this is just the visual representation of how the equal weighted index has so completely underperformed the S&P 500. What Liz Ann is talking about here is that tends to correlate with economic slowdown periods. And so, again, I think at some point, you're going to want to buy all of the RSP or the equal weighted index that you're going to get because those tend to reverse. What we haven't seen here after that October low of last year is that same historical pattern, but I do feel like it is going to come at some point, once we hit peak volatility in those Magnificent Seven stocks. Gold prices continue to move higher. We've got geopolitical tension. We've got the Israeli and Gaza conflict, and that's just one of the things helping to drive gold prices higher. And then we've got a couple of concluding charts here on China, just to keep our finger on the pulse of that. And we've seen fits and starts out of China. We've talked about China lately in a bit of a negative light, something that we want to pay attention to. We do see budget deficits higher in China overall than U.S. and advanced economies. We also see bank capital ratios be quite a bit weaker, and the real estate sector is in kind of broad disarray right now. We've got two of the major developers that are essentially defunct in China right now, and you can see these capital ratios when you're looking at and kind of comparing China to the rest of the developed market basket, really not in the same league. And then we've got projections for GDP growth in China. Again, a large economy getting larger, and you know when that happens, you get the law of large numbers kicking in, and you tend to grow less quickly. But as we look out into the next several years, you can see that China's growth rate is slowing down considerably, and this is something that is going to weigh on, I think, on global growth to some degree, you know, because other companies or other countries are going to have to pick up the slack. You know, China's been an engine for global economic growth for the last decade, and you know, I think it just spells the, you know, the potential for, you know, having lower overall global growth, you know, across all developed and emerging economies. That's all we have this week. Hope you've enjoyed the chart pack. Have a great week, and we'll talk to you again soon.